I learned a lot about how to think rigorously about macro, about markets, and about how to develop systematic approaches. And I think the couple of key sort of lessons, experiences, skills, maybe you might even say, that I learned was really really, I say first, this idea of thinking from the big picture all the way down to the practical reality and all the way back up, and having to make sure that those things all intersect with each other very well. I think that's um, often you'll meet people who might be particularly good at the big picture or particularly good at sort of the details of analysis, and that in order to really understand how things work, you really have to work at all those levels, which is important. Push yourself to work at all those levels. I think the other thing that was really critical to develop a skill set around was this idea of systemization, which, systemization you start to talk about and people's eyes, sort of glaze over, and they think you're just talking about a black box scenario. And I think, particularly also as people talk more about AI today, and then that's like even more black boxy
Yeah.
and like, what the heck is all this? And I think it was really a great environment to develop an appreciation for the fact that there's a set of tools that are out there, like AI, machine learning, regression, whatever, all these different tools, random forest. There's a bunch of different tools that you can use that are quantitative techniques to help you express an intuitive or fundamental understanding, express and measure intuitive and fundamental understanding. But the way that works, at least as it works for macro, is that the direction has to be from the intuitive understanding to the use of the tools to then the outcomes and then trading markets. It's very important to think in that direction. Too often I see folks who are very deeply skilled in the techniques trying to go back to the intuition, and that doesn't work. And the reason why that is, particularly in macro investing, is because there isn't enough sample size to be able to really operate in a way where you can sort of use the techniques to infer the understanding, because the techniques, many of these techniques require a level of sample size to build their inferences that is, we've had 7 macro cycles since 1945 or whatever, like that. That's literally 7 data points. 7 data points isn't going to get it done. And so really understanding and appreciating where are those tools effective. Many sort of machine learning models are very effective in, say, short-term individual security trading with a time frame of 1 day. That's a very, because you have incredible sample size to infer from there, and incredible ability to bet on a lot of different outcomes, but definitely doesn't work as a solution to certain other problems, like, is the yield curve inversion, does that indicate a recession, and if it does, over what time frame? Like that is not a very good use of those sorts of techniques. So a lot of that, there was a lot of building that suite of understanding and toolkit that I can then apply in a bunch of different ways, as I'm doing what I'm doing now.
So when you say, you go from kind of the intuitive understanding, so would that be, for example, saying, bonds are, are safe, are kind of a safe asset. So therefore, in kind of a bear market, generally speaking, in a bear market, bonds should do well. And then after that, trying to see how bonds behave in a bear
Right,
market.
right. That's a simple. I always like to say, well, if inflation expectations rise relative to what people had initially expected, generally bonds will sell off. And
Yeah.
why is that? Because bonds, the interest rate on bonds is reflective of a combination of what people expect on the real yield, plus what they expect to get paid for inflation over time. And so, like, that's a fundamental, that's a sort of a simple fundamental understanding, intuitive understanding of how the world works. And then you can go back and you can say, is that simple intuitive understanding true or not true? Right? Is it, does it work that way, in all environments, in some environments, right? And start to build that sort of, and then the question inevitably comes, okay, so I just said that, and you're like, okay, yeah, if inflation is above expectations, bonds sell off. But but like, what does that actually mean in terms of how do you go execute that? How do you measure that? How do you figure out what's priced in? Like, this is not a trivial exercise.
Yeah.
But it starts with the intuition and then goes in that direction. And I think in particular, this environment has been really important to force people to start with the intuition, and start with the I call this the fundamental intuition, and then have to go and then go and measure those dynamics. And I think, like, yield curve inversion is such a good example. Like, everyone, how many people were like, well, the yield curve's inverted, recession is now. And it's like, hold on. Let's that's a good example of observing and inferring, observing and intuiting, right? Rather than saying, okay, well, let's talk about what are the fundamental drivers, the intuitive fundamental drivers of how the macroeconomy works, and how does the yield curve fit into that? Is it a reflection of the fundamental dynamics? Is it an indicator of what's likely to transpire in certain ways? Is it a reflection of market pricing? Is it a reflection of supply and demand imbalances? Like, all of those things are the fundamentals that you have to understand. You can't just sort of use the indicator and go back and say, well, obviously this is just how it works, is recession's on the way.